Good evening, friends. Welcome to our next edition of the E.M.I. Let me kick it off without much more delay. Let's start with the economy update. In the E.M.I, E represents the economy, M the markets, and I the investment suggestions. So if you look at the status update of the economy, the world economy, as you can see, ever since September last year, has been consistently downgrading its forecasts for the current year. Right now, it stands at 2.6%. The reason for this is that the PMI, which is something that I've explained in detail, is a very good predictor of GDP, is for the world in a contraction mode, reflecting the slowdown. At the same time, manufacturing PMI of the developed markets is in a much more contraction mode, offset by the emerging market PMI, which is actually on an expansion mode. So straight away you can start to see that the world growth is being held up by the emerging economies. Right now, within the emerging economies, you can see that India stands head and shoulders above the rest. So we continue to be the fastest growing country for the expected future. And if you then look at the share of the world GDP growth, you can see that it's Indonesia, India, and China, which are in a big bubble, which means their growth rates are the highest, which is what is reflected in this table here for 2024 estimates. India has to grow at 6.8, China at 4.2, and Indonesia at 5, well above the world growth rate of 2.6. So these three countries are effectively helping the world grow. And it's interesting to note that even projected into 2025, the next year, India, Indonesia, and will continue to be the fastest. In fact, India and China are further going to expand their growth rate. Based on which the actual numbers for this quarter at 7.6% GDP also reflects India's continuing status as the fastest growing economy in the world. This 7.6 growth rate, to be noted, however, is that it's the government expenditure which is keeping it up. Private consumption is still lagging, only a 3% growth, and private capex has not even started yet in a full-fledged manner. So, since the government is financing it, the debt of the government is for concern, but it's of no concern because we have kept it flat over the last 3 years at 80 to 82% of the budget. So which means of the GDP. So which means that on a risk perspective, we don't expect any negatives. The reason the government is able to do that because not only GST collections, but direct tax collections have shot up 20% for this quarter for an advanced tax basis. Hence, we don't expect any problem in terms of the risk assessment of India when the vote on account is presented on February 1st. We think that the forecasted fiscal deficit will be within the expected fiscal deficit. And we are getting strong remittances from our friends abroad, NRIs, and hence our current account deficit is also lower to 1%, and our capital account surplus continues to be strong at 1.2% of GDP. This invisible support is what is helping our current account deficit, right? And so the YTD fiscal deficit, as I said, remains at 5.7%. The slowdown that we talked about is seen in the two-wheeler sales, in the three-wheeler sales, and the passenger vehicle sales. You can see a noticeable drop. So clearly, auto as a sector, there is some amount of slowdown which reflects in the consumption number. But rural economy activity, which was also contributing to the low consumption number, seems to be showing an uptick this quarter. And the key point here is that there have been some moderation in trends in urban employment also seen, but our forex reserves are well above the $600 billion level. Import cover remains comfortable as a country. And then when you look at the various indicators, right, the key thing is that the moderation in auto sales and the rural wage growth, right, is driven by the rise in the wages in rural India from April to August to September, October. If you can see every year on year, the same period. This year, the wages are much higher. The rise in the vegetable prices and all of that has helped the wages improve. In fact, the Narega demand has also come down, right? See, Narega employment demand is also coming down. So that naturally gives us a feeling that the consumer sentiment index, which has reached the pre-COVID level, augurs well for a consumption taking place in the next few months. So the exception for the consumption, which is not growing, is the property prices, which are shooting through the roof, as you can see. And across the country in the top cities, barring a few, we have seen a pickup in new real estate sales. This has a positive effect, not only indicating that customers are willing to spend where they see value, but also at the same time that this has a multiplier effect on the economy in terms of the kind of industries which depend on housing to have a pickup: cement, steel, PVC pipes, copper wires to tiles to ceramic ware to everything, right? So from that point of view, the growth rate is also supported of the economy by a seaport and rail freight growth, which has witnessed an appreciable improvement, right? Rail freight is on this slide and seaport is on this slide. And our manufacturing and services PI continue to remain elevated, well above the 50 level, indicating an expansion zone, right? So while Citibank has a second half estimate of 6.4%, government's own estimate seems to be higher at 7% for the second half of the year. So from that point of view, from a capex cycle perspective, if you see that projects which are being implemented continue to be implemented, but new investment projects have witnessed a moderate, especially in the private, which I spoke about earlier also. So as a result of which, there is moderation in engineering and construction company order inflows, and capacity utilization, though it continues to be above the long-term average, hasn't really shot up the way it was expected after the second wave, right? So from that point of view, right, if you look at it, we have to wait for this to start, in terms of the consumption to first come in, boost the capacity utilization, then you will see the capex. So companies are talking about the capex. Ground level action is yet to happen, probably delayed by about 6 to 9 months. And then whenever that happens, there is adequate room within corporate balance sheets to take fresh loans to finance this capex, because non-NBFC debt has come down from 75% of GDP to 52% of GDP. And the credit quality in the economy continues to improve because CRISIL's upgrade downgrade ratio, you see, for every company getting downgraded, two are getting upgraded. And banks' NPA levels also have shot down significantly. Hence, overall, if you see, the economy can support the capex cycle as and when consumption picks up, capacity utilization picks up, and then private sector starts expanding, right? So from a commodity perspective, however, for India, it has remained range bound and is lower than the recent past, which is good news because we are a net commodity importing company, especially the crude oil levels seem to have stabilized, right? And inflation expectancy survey continues to see moderation. This is the future inflation that the people are telling when RBI does a survey. With that, we have a good picture of the economy that by and large it's in good wicket. To summarize, right, the world economy is slowing down, emerging economy are going fast. India is the fastest growing, and within India, so far the GDP has been supported by government expenditure, both on private, on capex as well as on consumption. Private sector consumption has grown very slowly. And second aspect is that, so hence private sector capex hasn't taken off because capitalism has got stabilized at around 76 and not going past the 80 levels. In the coming months, the consumer sentiment index has indicated a rise and come back to pre-COVID levels finally. And with the election season on us, you can expect expenditure into the economy from both the government as well as the opposition parties. And hence, consumption should gradually start seeing a pickup over the next 6 months, which should then follow with a capacity utilization increase and then a capex cycle starting. So that's the summary of the economic situation. Now we move to the markets. And so from the world stock markets perspective, we have to remember the whole world stock market looks at the US for direction. The reason for this is very simple. If you look at the world forex reserves, almost 60% of them are invested in dollar. So everybody worries about what's going to happen to US as a country. Is the dollar going to weaken? Then my reserves are going to come down in value. So because of that, we have to focus on the Fed's forecast for this year. In December, they came out with the forecast, which compared to September showed a slowing economy, but inflation also being under control. Hence, Fed boldly has said that for the next 3 years, they will do 250 basis points of rate cuts, 75 this year, 100 next year, and 75 the following year. So this rate cut scenario is treated differently by different markets. So if you see, the currency market shows that the green line is going down, which means the currency shows a weakening. Why is that? Because they see that the Fed is worried that the economy is slowing down and is desperate to pull it back, which means that the weakening US economy reflects in a weakening US currency. The second is the debt markets also don't like it. If you look at it, as of yesterday, a 3-month return of the 10-year GSEC had come down by 67 basis points. So which means that nobody wants to take on debt at the long end of the curve because they are anticipating a recession. So both the currency and the long-term debt markets do not seem to have taken this news very well, but the equity markets have taken it very well because this means that interest rates for people like hedge funds who borrow money to put in the bank into market will get money very cheap. Hence, Bank of America's bull bear is now tilted towards the buy zone, and Top of it, there's ample liquidity available in the US financial system, almost $8.5 trillion dollars, and fund managers prior to the Fed decision had kept about 5% in cash levels, and so they are likely to deploy the same just as when the Fed came was the feeling, and it happened. So if you see the S&P 500 ETF got $20.8 billion inflow in just one day. Writing back to the inception from 1993, this has never been the case. And last week alone, total inflows went to $24 billion. So this meant that the S&P 500's target has been raised from 4,700 to 5,100 for the year end, and the US stock market on a 3-month basis has now delivered a double-digit return. So from that point of view, if you move now to the India stock market, what we need to understand is who owns the stock market and who trades in it. So the ownership is 42% with the private promoters, but they don't trade in their stock. So removing that 42 from 100, you're left with 58 on the right-hand side table, of which you can see that 33% is with FIIs and 15% with domestic mutual funds. So hence, half the market is controlled by these two largest players. Within the FII, if you look at it, 24% of that is long-term money, which generally is a continuous buyer, and they invest in each country with a 15-20 year outlook and look at the share of the global GDP of that country to decide how much to allocate. So India's share has gone up, indicating our growth from 12% to 16%. We'll address the long-term money future potential in a few minutes later. Let's now look at the hot money, which is the short-term money, which is mutual funds and hedge funds, which account for 68%. Now, there are two types of mutual funds. There are passive mutual funds, in which case, if you look at the emerging market index, where passive mutual fund have to allocate to India, in 2014, we had 6.4% share of the emerging market index. Today, we have 15.5% share of the emerging market index. So almost 2.5 times our share has gone up. So naturally, increasing allocation would happen to India, which is the truth that for the last 3 years, ETFs have given positive every single year. In fact, the active money, non-ETF money, has been flat sometimes, negative sometimes, and marginally positive, but the ETF money has been consistently flowing in. So this short term, which we may call it the money, is not under threat. Active overseas mutual funds, also a very similar situation, because a poll of international fund managers showed that 28% of fund managers are overweight on India, which means they allocate more than the index to India. So if you see, the average is around 16.5%, and there's the change post-COVID is that 7.4% our share has gone up with the actives, whereas China and Russia have seen a dropped by 4 and 9%. So clearly, active mutual funds have also been buying more and more of India allocation. Now we come to the third player in this whole short-term play, which is the super active fund, or called as hedge fund. Now, in the hedge fund, what they do, when they look at the emerging market in India, they look whether the situation at home is conducive. So which means they want declining inflation, which will lead to declining interest rates, which is good for them to borrow. And then they want a declining currency, because if their home currency is weakening, then emerging market currency will not correct that much. And finally, there should be liquidity available. We look at these four factors, but in the meantime, we all know that emerging markets are growing faster than the advanced countries, and India is also growing faster. So from an attractiveness perspective, no issues. We'll look at these four factors now. So when you look at inflation, throughout the world, the rate hikes seem to have taken effect, and inflation is by and large down to the low single digits across the Western world, right? India, in fact, now is among the higher countries with inflation at 5.6. The next is, this has obviously led to the rate cut scenario, which we just spoke about. You're seeing rates declining about 67 basis points in the long-term rates, and the dollar is also weakening, right? So both these factors are now conducive. So that leaves liquidity. Now, global liquidity, despite $3 trillion coming down, is still got $25 trillion of liquidity available floating in the world. So hedge funds have ample liquidity to borrow. So now when they look at it, automatically emerging markets should get some flows, and then India should get the flows. But as far as India is concerned, the oil prices come and impact the currency valuation. Why? Because 83% of our oil we import. When oil prices rise, FIs look at these 8 things on the slide and say, this is going to hurt my money from India. And so they pull out money when they see a rise. At the same time, when oil prices go down, the same 8 factors can turn into green, and then they say, oh, I should invest in India. This fact is shown very clearly by this trend line of flows vis-a-vis crude oil prices. The bottom graph tells you the crude oil price trend, and the up table tells you the inflows in green, outflows in red. So as you can see, during COVID, oil came down from 60 to $20. For 6 quarters, you had continuously FIs putting in money. Then the Russia-Ukraine crisis started. Oil went all the way to $125, and in 3 quarters, they removed what they brought in 6 quarters, almost 90%. They pulled out. Then, when the oil hit 125 and US inflation peaked at 9%, Fed announced very strong rate hikes, cool down the economy, and hence, if you can see that the FIS came back in a declining oil scenario. The January, February, March quarter was an exception because of Adani and also because during winter, oil tends to spike a little bit. So there was a anticipated, because of that, they kind of pulled out the money. But once April happened and they realized that the Adani factor was not a big factor in India, they came back in double strengths to bring in 100,000 crores during that period. Then this September and October, again as the winter processed, you saw the oil prices rise and the FIS outflow again started. And in fact, the oil price should have continued to rise and the outflow should have continued. But what happened was that because the US was pushed into a corner, they lifted the sanctions on Venezuela and Venezuelan oil started flooding the market. So this brought down the oil prices. Further, we also saw because of the Israel-Hamas conflict, Iran, which is actually financing the war, actually started pumping more oil and exporting to finance the war. So Iranian oil and Venezuelan oil both combined together, supply came in. And even during a winter, you saw a declining oil price. Hence, in the month of November, you saw a net inflow of 9,000 crores from FIIs. So this summarizes, and I hope you're very clear that short-term behavior of short-term FIIs is largely linked to the trend in oil prices. Hence, now when you look at it from a future perspective, you realize that it's OPEC who drives this because they have to supply about 30 million barrels of the net gap, but they supply only 27, 28. But because now a Venezuelan Iranian oil has come, the oil prices have started trending down. And you are also seeing that this year, you will see that for the next 6 months, it will be stable. And then once you see that during March, summer starting, it will do a decline and then a flattish oil. So the futures oil price is clearly saying that it's very supportive for hedge funds to remain invested in India and put more money into India. Looking at domestic flows for a minute, the same quarter by quarter, I have compared the domestic flows. So apart from the 4 quarters of COVID, right, when domestic investors pulled out money from mutual funds and mutual fund managers was forced to sell, we saw that continuously domestic mutual funds have been buyers in the market. In fact, if till November 30, if you take the total buying by these two, 5.5 lakh crore, 60% share is of MF and only 40% of FIIs. And hence, FII share actually declined to about 16.5% of our total. And mutual funds, which were historically at 45 and below compared to FII, today have come to 55, FI has come to 45. So clearly, in that period, domestic mutual funds are a big part in not only protecting the market from downturn, but also boosting up the market. Hence, from a valuations perspective, if you look at it and take a look at the earnings of stock market companies, this quarter with a GDP growth of 7.6 and an inflation of 5.6, that is nominal GDP grew at 13.2, we saw market earnings actually at 18, 19. So markets are doing far better than the economy and capturing the value in the economy. Hence, if you look at it from an analyst beating estimate, right, 55% of companies have beaten the analyst estimates for earnings in this quarter, and hence the full year earnings have been upgraded to around 20% for this year. So everything from an earnings perspective looks solid, and from a valuation perspective, you have to look at the valuations of from a FII perspective relative to the world market and other emerging markets. So where are the world markets trading? The US is at the peak in terms of 20 as a PE. Emerging market is the lowest at 11 as a PE, and Europe and Japan, which are the other two developed markets, are somewhere in between. India, as an comparison here, is trading at a 90% premium to the emerging market and a 38% premium to the world market, right? So from that point of view, India is very, very highly valued, and the average premium we have reached are 58. Now, when you look at it, why are FIs willing to pay a premium to India related to the markets? The market comes from the market volatility. As you're aware, even in domestic, fund managers give a higher valuation to stocks like FMCG, which are less volatile, and hence called low beta, versus in stock like L&T or BHL, which is considered high beta, and hence, though it's a high growth stock, there is greater volatility. So from a volatility perspective, if you look at India from an earnings perspective, I draw your attention to the year 2024. The estimate for 2024 Nifty EPS in 2021 was only 917, and today it's 943. Over the last 2.5 years, our estimate for this current year has not changed. That tells you that our stocks, India is a stock in an FIS world. Okay. So this stock is delivering an earnings consistently. So that's one reason why we pay a premium. Second is the churn in the market has come down dramatically, because the length of the stay of an FII and a domestic investor has gone from 16, 17 months to 35 and 45 months. So this means that when people stay for longer in the market, the churn is less, and hence the market volatility is far less. So if you see Indian markets volatility, it is been consistently lower than the world market volatility. Hence, if you see our beta versus the emerging market beta, we have been consistently falling. So we are moving towards being a more of a defensive stock. And I think that's the reason we are willing to get a premium. And then having invested at a premium, we have also delivered very good returns to FIIs. If you look at those who put in money during COVID, and from there compare the entire world set of markets, it's the Indian market and the American market which has delivered the best return to the FII. So the short term to medium term FII has got very good returns despite investing at a premium. But the long-term FII, if you look at them, that is the sovereign wealth funds, the pension funds, on a 20-year basis, India has delivered 12.5% per annum in dollar terms. Indonesia delivered slightly better than us, but on a 10-year basis, we have delivered 7% in dollar terms, whereas Indonesia has been negative. So clearly, despite investing in India at a premium of average 58% over the emerging markets, FIIs have made money both in the short term and in the long term, right? So now when you look at domestic fund managers, we don't look at other countries, we look at our own history comparison. And there, when you look at it, we are today trading. The red line is the long-term average, which is about 19.5. And we are trading today closer to 20, which is higher than our long-term mean. But this is, I would say, not a cause for panic, because we are nowhere near the highs of October 21 or December 17, nor are we nowhere near the lows of December 20. So we are, I would say, reasonably valued from a historical perspective. We now move to broader market, which is mid cap and small cap. As this table shows, in March, mid cap and small caps were actually delivering negative returns on 3 months, 6 months, 1 year. But today, and 3 months, 6 months, 1 year, they have delivered much better returns than large caps, right? Mid caps and small caps. What is the reason for this? The earnings growth, the last on the side, I have circled it. After the October 21 peak, the earnings have more or less been 52, 50, and 58 for the large, mid, and small. So earnings growth has not been the reason for the division. So what is the reason? Is that the valuations have expanded. If you look in April this year, mid caps were trading at 8% discount to large caps, and small caps at a 3% discount to large caps. Whereas if you now move to the November period, you can clearly see that there is a shift in terms of 14.5% premium for both mid caps and small cap to large cap. The reason for this, if you see, is that fund managers, because of the domestic flows, have shifted much of their money in large caps from large cap to mid and small cap. Circle fund managers have taken the large cap component much lower. Similarly, in flexi cap also, you're seeing a lot of fund managers have reduced. So this drove the first wave. The second wave which came across was that Japanese FIIs, who brought in a lot of money, raised money in Japan of 60% large cap, 40% mid cap. So some of the money from FIIs came directly into mid cap stocks. The third is, of course, the retail investor behavior, who have favored the small cap segment in terms of incremental flows. As you can see, there's been a decline in large cap flows, but a strong increase in small cap flows right from September to December, and even from April to July. So as a result of this, today small cap folios have exceeded large cap and mid cap folios, and there's been about 80 lakh folios additional come into small cap. While SEBI is worried about this as a risk because large number of retail investors seem to have entered the small cap space, we can take comfort from the fact that the rising SIP book is largely contributed by the mid and small cap. So mid and small cap today account for 30% of the SIP book, and multi-cap another 30%. So half of the multi-cap means almost half of the 17,000 crores is coming into the market to buy mid and small cap every month. So far the volatility has been well controlled. right? So from that point of view, if you now look at the long-term growth capital flows, which can also come in the short term, I will quickly say that the share of global GDP is the important thing. And here, the biggest thing favoring India is the center of gravity shift from China to India. And there, if you look at it, clearly the India has exceeded their population. We are a rising population till 2060. China is declining from 2017. We are 10 years younger than Chinese and average. So if you then see over the next 10 years, China is going to lose 3.2 crore people from the population, but India is adding almost 10 crore people. That is 22% of the addition to the world's population by a single country. So clearer labor supply is a big advantage. China used this labor to gain a market share in the exports of 13%. We are still at 2%. So Indian government is clearly focusing on manufacturing. A lot of initiatives have been announced there to take our manufacturing share from 15.5%, which is there today, to about 27, 28%, which China has. It will take a long time, but the journey has started. We are aided by the fact that our manufacturing costs per hour are among the lowest in the world, along with Vietnam. China is at 4.2, we are at 1.6, US is at 30. So clearly the way forward is to replicate the China export success story. And for that, we already produce the largest number of engineers, and there's a lot of focus on infra by the government. If you see these slides, the railway budget allocation, the railway electrification, the rural road network, the national highway network, and the turnaround time drop in the major ports of ships, and rural electrification, as well as, the focus on infra itself is leading to a job creation potential, right? So from that point of view, with these jobs getting created, consumption should be a next big driver, because our per capita income is poised to double from 2,200 to 4,700 by the end of the decade. And we are also seeing a sharp divide between the rich and the poor. And so today, 10% of India's population controls 74% of our wealth. So this increase in per capita income also accompanied by the rich getting richer. So strong consumption drive from the rich and the middle class as they upgrade their lifestyle will be aided by the amount of money being spent in rural. I mean, rural incomes will go up, and the urbanization story also creates its own driver for consumption. So retail consumption market India is slated to triple from 700 billion to 2 trillion just in the next 5 years. And within that, e-commerce from 60 billion is going to shoot up to 400 billion. So that brings us from an e-commerce perspective to the services segment. And you see the digitization, formalization has changed our lives in the services space in a huge manner. I've highlighted some of the things which is happening. And there, when you look at it, today, India's data pricing is the lowest in the world. And our smartphone today, 66% of our population owns smartphones. So as a result, you also see rural internet users are growing more than double of urban. And so India's data volume consumption is the fastest growing in the world. And the Jandan Yojana, what we achieved, BIS, Bank of International Investment, says that what will take 47 years, we have achieved in 9 years. A phenomenal achievement by India. And UPI payments are a huge success story. Just from pre-COVID to now, they are up 10 times, right? And so using all this digital infrastructure, India has now started gaining a share in the non-software outsourced services. Professional management consulting from 5% has doubled to 10%. And that's why you see 90,000 companies have set up new startups from just the last 6 years in India, of which 100 have gained unicorn status, which is $1 billion market cap. It is from this 100 that the future stock market listing will happen. 10 of these only have listed, still 90 more, and the future unicorns will provide the stock market also with the opportunities, right? And hence, these are the big drivers which are going to drive Indian growth. So manufacturing plus services plus private consumption is going to help us to triple our GDP in the next 15 years. And how 2023 to 27, we will continue to remain the fastest growing country in the world, and hence poised to go from the fifth rank today in the world by overtaking Japan and Germany to reach the third rank. So naturally, our share of global GDP is poised to go from the 3.1, 3.2 to 4%. So that much incremental long-term capital can come into India. And besides that, from a beta perspective, you see the recession in the world leads to all the economies suffering some growth loss. India and Indonesia are the ones going to suffer the least growth loss. Hence, that beta of India will continue to keep coming down, and we can expect more of capital allocation from even long-term FIIs. Hence, the month of December, which saw the December 3rd, the election results come out in the heartland of India, which came strongly in favor of the NDA government. So the confidence in these foreign investors that there would be continuity of policy with the government coming back to power has gone up, and hence this month has seen a 66,000 crore inflow into the market, as a result of which you've seen domestic fund managers also start to buy large caps, mid caps. So because of which the mid caps are now increased in valuation, small caps have slightly come down from 14 to 10 as a premium to the large cap. So with that, the January story continues with another 4,000 crores of inflows up to January 12th. And you can see that now the difference between the large cap and the mid cap and the small cap has narrowed on a 1 month basis and on a 3 month basis. And so you can expect that over the next 6 months, we do expect that the markets will rally. And already, if you see, based on these flows, you are seeing that whether it's excluding Japan, which is a developed market, you see 1 month, 3 month, 6 month, 1 year, 3 years. India is the best performing market because we are the ones who received almost $25 billion of flows. And this has taken our market to a 4.2 trillion market cap at 3.8% of the global market cap share. And that makes us the fifth biggest equity market just behind Hong Kong. What are the reasons this has happened? One is the mutual fund industry by reaching 50 lakh crore, adding new investors and consistent SIP flows has contributed to this growth of the market. Second is that we've also seen that besides the stock market return of 20% to foreigners, India has also brought in 58 new companies into the capital market through IPO who have raised 53,000 crores. So all these combined together has given us a very strong position of growth in the world equity markets, right? So from a short-term outlook, I would say with the FIS coming behind, you can follow a flexi cap, large and mid cap kind of an allocation, which is what I've indicated here. And 6 months later, we can reevaluate the situation. Now, from a medium term perspective, right, from a domestic capital flows, the same increase in per capita income will mean that you will have a greater savings growth. Like the previous time it doubled, savings grew 3 times in banks. This time onwards, what is happening? Because of the polarization of the wealth, we think that there's a huge potential for mutual funds to grow. It's only 2% of the total financial savings today. And already we are gaining share on market share on deposits. From 14% of bank deposits, today we are already 22%. And the scope for our market to grow is huge because US is at 120% mutual fund assets to GDP. We are at 12%. And our penetration is only 3.4 crore, the 5 crore mutual fund investors against a 140 crore population. So the road ahead is very large and very wide. And hence, from a medium term outlook, if you look at it, right, I would like to skip a few slides now and get to the conclusion, right, which from a medium term perspective, I feel that your allocation can be better put into a kind of a flexi cap, large and mid cap, multi cap allocation because different parts of time, mid caps and small caps and large caps perform. While in the short run, I expect large caps to perform. There will be time when mid caps will do well. So I think giving it to a fund manager who can reallocate it within large, mid, and small as per the kind of view is better. And if you don't have a very clear cut view, then the 30-40-30 should take care of it from a balanced approach towards large cap, mid cap, and small bank. This is all for an aggressive investor, right? And then when you go into a moderate investor, we should look at the multi-asset allocation, aggressive hybrid, BAF, and equity savings as the ideal combination of portfolio because these funds come in the middle of the risk-reward framework. They are never as risky and high reward and high risk as equity, nor as low risk and low reward as liquid and other short-term debt funds, right? So moderate risk investors, remember, want a long-term inflation and fixed income beating return with a lesser risk, right? So if you see, the industry has by and large delivered to this mandate. Well, aggressive hybrids have delivered 11%, BAF has delivered 10.5%, and equity savings. This is the average of the category in value research. So clearly, they have beaten inflation, and clearly you can see that on a post-tax basis, because these are all equity taxation funds, they have delivered at least 70 to 80% better than post-tax returns of bank deposits and other FDs, right? So they have delivered to their value. But what has recently happened is that ever since the current year, you've seen a sharp diversion of money from BAF into multi-asset category, right? You can see the circle numbers there. What is this multi-asset category? What has happened to it? This category came to life suddenly after the finance bill, when the taxation around the debt and commodity ETFs was removed, the indexation benefit. So if people want to participate through that, it's only now through a hybrid category that you can participate. And multi-assets are the nothing but an hybrid plus commodity. That is the other hybrid funds in which you add commodities, right? So if you see here now, the category average of this has been very good because the commodity cycle has done well. So on a 1 year, it's given 21%, on a 3 year, 15%, on a 5 year also, it's delivered 15%. And some of the largest funds in the industry have delivered somewhere around the 1 year, 3 year category average, they have delivered. So the category has delivered very good returns. There's a taxation element also advantages to it. So because of which the SEBI categorization basically says 10% to equity, 10% minimum to fixed income, 10% to commodities. And within that, right, you can alter it. So many fund houses are launching equity taxation oriented, some are launching debt taxation oriented funds. And these come into position that they are in the same risk band as BAF funds, but can deliver better returns than the BAF category. Now, one of the key, very commonly used commodities is gold. So if you look at what gold has done and how that has helped these multi-asset funds perform, you can see that over the last calendar years of 13 years, gold has outperformed equities and debt 50% of the time. 7 out of the 13 years, gold has been the best. So naturally, gold seems to have a standalone quality of its own in terms of adding value. And if you look at the historic performance of gold, gold acts as a shock absorber. Now, this word shock absorber I'm using from an automobile field. So when you compare on a BAF, you have a debt and arbitrage, and you in the MAF you have a gold or commodities like gold. So when you say gold, it acts as a shock absorber in a vehicle. So whereas debt and BAF acts like your speed controller in a vehicle. So what do I mean? That a speed controller, you say it won't go more than 60%, then automatically you know that it's going to be a very, very difficult task for it to it supports you at the bottom, but at the top, protect yourself from the suspension of the car as well as the suspension of the back from the thing. But at the same time, when you reach a highway, the speed controller prevents you from speeding off. So debt and arbitrage acts very good in absorbing the pressure, but they never give more than 6 to 8% return, as you have seen from this historic. See the right-hand side, you see debt minimum of 6.1, maximum of 8.3, right? So they do protect you from the shocks, but they don't give you support when it goes up. Whereas the shock absorber in your vehicle is a silent performer. It absorbs the shock because it's got that capacity, but in the highway, it speeds up and it helps you speed. So gold acts like that. So as you can see, gold has the capacity to deliver sometimes 20, 23% also per annum. So from that point of view, if you see the point of view, why this gold gets this behavior? Because during recessions, gold does well, whereas equity doesn't do well. Similarly, sharp shocks in the market, right? You see Nifty delivering a big correction during those short periods, but gold delivering a big positive. Why? Because big investors actually redeem equity when they see those threats and take that money and put it in the gold, so that lack of demand for equity and the sharp increase in demand for gold shows you this. So that's why gold tends to not only just protect but also deliver value, just like a true shock absorber. So now when you look at a detailed performance comparison on a rolling returns basis, I've taken the history of the MCX gold price index from 2005, October 21st. So it had a 18-year journey. In that 18-year journey, you could have done investment every year, right? So 18 into 365, you will have about 7,000 periods. But since you have to stop 1 year before today, you have 6,250 1-year investments and so on and so forth. So out of the 6,250 1-year periods, in 1,200 periods, Nifty was negative. If you did an investment on the same date in gold and equity, out of those 1,200 periods that Nifty was negative, 90% of the time gold gave you positive returns. So it gave you good support. And like I mentioned, sometimes that support is a very high support. And then another 6%, it was also negative, but not as much negative as equity. So it gave us some alpha, some protection. So 97% of the time, gold gave you a protection when Nifty corrected. Right? Number one. Now, debt would have given you 100% protection because it's always 6 to 8. But when you come to the other 80% of the period when Nifty was positive, you see the value of gold as a shock absorber. Because in 36% of the times that Nifty was positive, gold beat the Nifty. So it has the power to turbocharge even when Nifty is positive. Another 38% time, it went hand in hand with equity as positive, but it was less positive. So it didn't create a destruction in wealth, but it didn't create an alpha vis-a-vis equity. In the balance 26% of the time, only gold was negative and equity was positive. So naturally, this kind of a behavior shows you that the correlation between the two is on the negative side. But before we go there, if you look at the combination of the two, right, you can see that in 1 year and 3 years, 48% of the time gold has beaten Nifty. And in 5 years and 10 years, it's 40% almost. And in 15 years, it's 58%. So clearly, gold should be there in the portfolio to half the level. But, it's not necessary that you put full half, but significant proportion of gold in the portfolio makes sense. And hence, if you see from that perspective, gold has delivered a average return of 12% per annum. So it's almost as good as an equity asset class on its own. Equity delivers higher, but gold at least around delivers a double-digit return most of the time, right? So from that point of view, if you see that, I'm skipping these slides, I'll come into that in detail a bit later. But gold and its equities behavior are sometimes very opposite, sometimes they go together. So this combination of things is what is referred in correlation as minus 0.09 correlation. Hence, based on this, you can say that equity investors should always invest in paper gold as an asset class, regardless of the nature of the investor. Because if half the times it's giving you protection, right, then it's good. That means it's a combination of what? It's a combination of positive returns when equity is negative, plus it's a combination of better positive sometimes when equity is positive, right? So to that effect, every equity investor should always invest in paper gold as an additional asset class. And the reason these data shows up like this is because the logic of the case is that for a long-term equity investor, over the business cycle, the periods like slowdown to contraction, contraction to recovery, recovery to expansion, there are periods when slowdown to contraction, debt does well. Contraction to recovery, recovery to expansion, equity does well. But that equity expansion to slowdown, gold does well. So you can't live life in the markets without facing all of these cycles. So there is a time when gold comes to the aid, right? So keeping gold is a very sensible decision. That's number one. The second reason for this is that it gives you protection against currency depreciation. So if you see 5-year periods of gold returns, there's always a currency component which aids it, right? Or sometimes detracts if it's currency appreciation, right? So the currency depreciation always aids gold's price. And if you see historically, India has seen 47% absolute devaluation over the last 23 years, but 2.74% per annum is the devaluation that's happened. So that you can look at addition to your portfolio. But in shorter time periods, like 10 years, you can see sometimes there's been 3 to 4% devaluation. Whereas in 5-year periods, there will be 5 to 8% devaluation. And in 3-year periods, you've even seen sometimes 7 to 9% depreciation. So these depreciations, whenever it occurs, if you have gold already in your portfolio will benefit from the rupee price of the gold. So that's the beauty of saying that for every equity investor, it's important to have gold in the portfolio, right? So now, based on which, let's just take a quick look at the current outlook for gold, and you will see that gold's price movement is based on the economic outlook. So soft landing, hard landing, no landing, the probabilities of those and the implied gold performance tell you that in a soft landing, gold is generally flat with an upside potential. In a hard landing, it has a notably higher upside potential. In a no landing, it is flat but with an initial downside pressure. That's the case of gold. This is what is chilled out in a more detail in this slide. So by and large, the economic scenarios today are supportive for gold. The other thing which is happening is the rate cut scenario. Now that the Fed has announced a rate cut, you will see that previous rate cut cycles have seen an appreciable increase in gold prices, right? So that's another positive view. Gold. The third is that the currency weakening, which happens when rate cut cycle happens, means that though 50% of jewelry demand comes from jewelry, you can see that investment by central bankers accounts for 11% of gold demand. This is a 10-year average. And if you look at the assets of global reserves managers, 50% is in dollar, 16% is in gold. So they toggle between dollar and gold depending on the currency outlook for the dollar. So when you see there's a weak dollar, then there's a strong gold because central banks become heavy buyers of gold. For example, currently they are buying 33% of the monthly global demand, whereas you saw the long-term average is 11%. Who are the buyers there? 9 of them are from the developing world, especially Russia, India, and China. And this is largely a vehicle of a central bank revolt because Russia and China obviously don't want to keep more assets in dollar. It's a revolt against the dollar. Hence, over the last 2 years, from an average of 400 to 600 tons of gold purchase, central bankers have bought 1,000 tons of gold each in the last 2 years. And who's these buyers? As I said, it's the BRICS. So if you look at the BRICS countries, their treasury holdings are falling. The green line is the proper BRICS, and the above that, the light shaded line is the BRICS Plus, where recently Saudi Arabia, UAE, Argentina, Egypt, Ethiopia, Iran have been added to the thing. So they're all reducing their treasury holdings of US dollar, and all of them are increasing their gold reserves. So this is a strong driver for gold, and that's why gold has now reached a kind of a lifetime high. And if you look at the outlook now in December with the Fed talking about a rate cut for next 3 years and the moderation in the US economic growth and the central bank buying continuing, one particular expert on gold expects that from its $2,000, it should end the year at about $2,400.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.